You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. Today we're talking about 162 double bonus, and this time we're talking about using indexed universal life and their arbitrage or participating loans with a new twist.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant, your host, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain, and day 4. With us, Ken Davis. Hey, Ken.
Stephen, good to see you again.
I'm doing great, and you look pretty good. I haven't, like I said, I just had him on all this week after not having you on for about a month or two.
Yeah.
It's been a long time. Ken's a CLU, CHFC, CFP, and CPA, former president of the local chapter as well of the CPA community, and my personal emissary to the CPA Society. Both Ken and I have taught at the Society, and we really enjoy our relationship with them. And of course, Ken, we bow to your fiduciary credentials. Okay, well, that out of the way. Now, we've been talking about 162 all this week. Tuesday, we opened up the basic idea of 162 double bonus.
Right.
And again, if you've missed any of the show, you need to go back out and watch them in succession. Start with Monday's show. We recommend it. Just hop out to our site, www.brokersalliance.com. As soon as you come to our homepage, you'll see the big red on-demand button. Just click on it, hit the archives, and watch those shows in succession. Now, yesterday we talked about the employer loaning it, but now today we're going to talk about pulling it, and we're going to feature a carrier. We did yesterday, now we're doing it a carrier today, ING. ING has come up with their idea called their solar program. That solar program allows you to actually pay the taxes due out of your policy at the end of your that's phenomenal. I mean, think about that. How is it working? Well, they have a 6% loan with a 1% floor guarantee. So really, we're talking 5% in that first year, and that's my loan charge if I want to take that money out and pay my taxes. Ken, I don't know about you, but that's a different twist.
Well, it is, and the longer you can put off actually paying the taxes, the better, as we saw with the AXA plan. But now we're talking about where the taxes are still due now. The employee is going to use the cash value that's built up in the policy to go ahead and pay the taxes. Now understand and remember, we're squeezing down the insurance costs, we're maximizing the cash values. The ING product has been designed to create cash value fairly quickly to help support this concept. And so now the employee takes it out. And you might ask the question legitimately, well, gosh, how is that different than if the employee just paid the tax? He's just getting the money in there and turning around right away and giving it away. So how does the employee benefit? Well, your comments about the 6% locked in cost of insurance on the loan, couple that with the indexing strategy, and there's the potential, and a key word is potential, for making an arbitrage spread. And we all love arbitrage, right? Because they have the potential of making higher interest on the indexed account than what they're paying on the loan, which is kind of an interesting commentary if you think about that, that these insurance companies are willing to let you do that. They have a lot of confidence that these things can get done. But the key here is 6% loan, so if you make 7 or 8% on your indexing strategy, great. However, this is a loan. Loans always can cause trouble the other direction. If the cost of the loan exceeds what you're getting credited, like you get a 0 interest credit, or actually 1% on this contract because the market's down, you're going to see that cash value drop. And then there might be other years where you make, what's the high-end cap on the ING at this point?
I think it's all double digit. I can't
remember.
Exactly.
Somewhere around maybe around 13, say. If it is, you could make that spread between the 6 and whatever the cap rate is at the time, and of course we know that changes. So leverage is very useful in building wealth, but always remember, it's a double-edged sword and come back to cut you.
We've done several tests on this from a proposal point of view, and we took the last 10 years, so I figured might as well. They've been bad.
Yeah.
So I took 2001 to 2011, the last 10 years. 4 of those last 10 have been bad for the S&P.
Sure.
Now, heads up, think about this. They'll allow you, that product also allows you to do their triple bucket idea, where you're using different indices, 2 of which are foreign, and the one domestic is the S&P. But I'm going to just talk about the S&P just to kind of dramatize the math a bit. So in 2001, 2002, and 2003, and 2008, we had terrible years where you would not have been credited. So I like to talk about the worst scenario, not the best scenario. And so when I look at that, and I've looked at the pressure for the early cash values, and that was the worst scenario, and then I tried to score it back out and figure 20 years, 30 years, that actually made the pressure points. Now remember, when I say about that, I want to be clear, that's with us suppressing the death benefit all the way down to the ground. Sure. We're doing everything we can to mitigate costs on the contract. So we looked at this, and it really did a pretty good pressure test, I'd have to say, under the worst scenario. I also did the test during the actual distribution. Not only am I, because I'm taking a loan out to pay my tax, I don't want to pay it out of pocket. So now my employer is paying me the premium. That's great. Now I'm taking the taxes due on that premium in my bracket, whatever that is. I'm taking that out of the policy, and I'm paying my taxes with it, so I'm not out of pocket. And I'm hoping, my goal is that over the long run, my policy will be able to generate the funds to pay the taxes due on every year of contributions.
Well, what's interesting about that comment is by managing in that way, having a contract that obviously ING gave a lot of thought to when they designed it, the beauty is that while we have the warning of the double-edged sword, at the same time with an indexing strategy, we have years where we have some of the upside potential of the market and none of the downside when things are bad. So it's great that you've done the pressure testing, because that says, well, yeah, that's a risk, but it's not as major a risk as it could be with, say, like with a VUL product.
And you know, their global strategy, having 3 buckets, your worst of the indices is going to be tossed anyways, and you're only going to be using the other 2. So they're trying in every way to try to hedge their positions, try to give the client an actual possibility of actually making these contracts do what they said they'll do. And now, I don't want to pay my own tax on my bonus. I love that. I can pull it out of the policy. That's my goal. Somebody else's money. I love it. Well, remember, you can contact me at thebiz@brokersalliance.com or call us toll-free, 1-800-290-7226. You can watch this show and all our shows at www.brokersalliance.com. When we come back, we'll talk more about double bonus with ING.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Companies in our business are always touting service, products, and underwriting. And we do that too. But here's the difference. Now enter the world of the elite producer with a value package that cuts us out of the pack. A BD that approves social media marketing of non-FINRA products and doesn't take an override. With the best competition desk in the industry, and for our loyal producers, a true group health plan. No one offers that. Brokers Alliance does. Well, welcome back to the Business Insurance Zone. I'm your host, Steve Savant. I'm here with Ken Davis. And remember, before moving forward with anything that we talk about in this show, especially talking about tax issues and 162, always consult your tax advisor, as well as if you're FINRA licensed, always check in with your broker-dealer compliance department before moving forward. And again, our broker-dealer compliance department is a great compliance department when it comes to non-FINRA communication. They're very benevolent. If you're looking for a new broker-dealer, they don't take haircuts on any of your comp, and their E&O is $70 a month for full coverage. Their app fee is like $400 for your state. It's a pretty good deal. If you're looking for a BD, just write me, thebiz@brokersalliance.com. I'll send you all the information. Ken, when we're talking about ING's indexing, I love their global strategy, because that's really great. It gives us a chance of actually winning, right? But I really like the ING issue on this solar product for 162 bonus. I mean, it really fits the bill. Here's how I'm looking at it. Stop me. Show me where I'm going wrong.
Okay.
My employer gets to write off the premium he writes to me, the rainmaker, who he wants to keep. It's a great retaining tool, this 162, and it's a great recruiting tool. All right. Now, my employer, but he doesn't want to pay the taxes. Now, I don't want to pay the taxes either. Well, somebody's got to pay the taxes. Now, I'm using the policy at the end of year 1, taking out whatever taxes are due on that bonus from the policy, and now I'm paying my tax. So my employer's getting to write it off. I'm not paying taxes on it. I am, but my policy's doing it for me. And by the way, let's make sure we got the semantics right. That's why I'm asking you this. That's not a deduction. That's not a tax credit. It's just reimbursement from my policy. I did have to pay the tax.
That's right. And it's not really reimbursement. It's a loan from the policy. And we just want to be real careful about our terminology
here.
here.
I want to be real careful.
Yeah, from a tax law perspective, a loan is not income, nor is it a deduction on the other side of it. So In our prior show, we were talking about where the employer loaned the money to the employee, and they had to get interest on it. However, in this case, the financier is the insurance company itself, and they're allowing you to make potentially a spread on what you earn on the index minus whatever you have to pay in that 6% cost. And even in the worst year, they'll credit your account at least 1%.
So I'm looking at contracts right now. Most people are, and I'm not saying you have to do it this way, but I think if you want it to be really fair, sometimes I'll show, because I have to from a competitive point of view, I'll show the 20 to 30 year look back. Because this is going to be part of paying back this loan. I got to look at it. I'll also look at some of the Monte Carlo theory that's done on these two 20-year tranches. If you haven't seen the report, just ask me for it. One of our other carriers put it out. It's excellent.
Oh, great.
And it's at, I now look at what I call booking quotes. I show the look back at whatever it is, let's say 8%, but I also show that Monte Carlo theory, which is really strong, at 5.5.
Nice.
I try to look at the beginning. Now remember, most index products were built to actually perform about 200 basis points above whatever current interest rates are.
Right.
If a carrier wants to hear a new heads up from Steve, I want the ability in one proposal to show the look back rate, the 5.5 bottom end, and the middle ground where really it was constructed and designed at 6.5.
Right.
If I start looking at those 5.5 to 6.5, and as I said in the first segment, add those bad boy years of the S&P, the last 10 years, and I can beat that pressure test, I'm feeling more confident about how I'm designing it as an illustrator.
Well, yeah, and I think the industry gets a bad rap sometimes because we over-illustrate. We show higher interest rates. I remember back, when I first started getting involved in the 80s where interest rates were through the roof. I don't know what they're, 10, 12, 14%. They're crazy. And we thought we were doing good by dropping it down by 2 or 3%, and then years go by and interest rates dropped and plummeted, and even the conservative of us were running into troubles and stuff. So we have to remember that we want to be more conservative, rather undersell than oversell. And there is the possibility, and I'm not predicting, but if in fact you feel or agents feel that interest rates at some point will rise, given this massive debt that we have in our country, we may actually see the opposite happen, and a couple things happen. The two factors. One is the loan. If you've got something like ING, it's locked in at 6. That can't change. Some of these other contracts, the interest rates rise with bond indexes, and that could just turn the whole thing upside down. So that's an issue. On the ING thing, on the other hand, if the markets go up and we're having better years when the markets are coming back, and inflation initially hurts the market, but ultimately eventually companies respond and raise the prices of goods and services and start to become more profitable. In order to get capital, they have to be competitive with returns. We may find ourselves in a really good situation that way. And we don't know exactly what will happen to cap rates. Remember, cap rates will change, can change annually typically. It's possible that if interest rates are rising and the bond portfolio is reinvesting at higher and higher interest rates, we may see that the company has more cash to go out and buy the options to support these cap rates. There is a possibility we could see those rise, but we don't, again, we can't predict the future. But I would say in terms of downside, we're not going to see, it's unlikely we're going to see interest rates lower than we have right now. So I don't think we're facing the same kinds of problems we did in the 80s.
Well, I think it's an encouragement when you think about it, because we're looking at strategies and tactics that we can deploy using life insurance, and we're giving you the 162 bonus. Again, you can write me at thebiz@brokersalliance.com. I'll send you all the material. Especially, don't forget to watch tomorrow's show, because we're going to put some serious documentation of what we've been talking about and really help you walk through it. I'm looking at strategies with ING's indexed global strategies with their arbitrage or participating loans, and integrating their great 162 double bonus solar product, which I think is hot, and it'll really position you as somebody bringing something very good and new to the market. Well, don't forget, you can watch this show and all our shows on www.brokersalliance.com. Just go right out to that site, click on the archives, download the show, and remember, you can call us at 1-800-290-7226 for any of your questions.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, We're the news you can use.